All right, good afternoon. Welcome to your weekly take on the market. Today is Friday, August 16th. It is 1:05 p.m. The market just closed, 1:05 Pacific time. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investor Business Daily. The disclaimer, I got to go through it. I'm not licensed. Can't tell you what to buy, what to sell, how many stocks to own, et cetera, et cetera. These webinars are vetted for compliance. This helps me so that I can speak more freely on the webinars and IBD Live, for example. So, and like I mentioned last week, it really is a true perk to being able to invest my own money freely in the stocks that I want under a compliance umbrella, but fairly freely. And so most of us, if not all of us, are in there with you. I definitely use these products to make decisions for myself and my own money. Okay, so overall market thoughts. I don't have any screen grabs today, so we'll jump right in to the indexes. And it's been a crazy week, and it's exciting. Allegedly, Confucius says, "May you live in interesting times." I don't know if we could ever prove that he said it, but I love that. And the markets are very interesting. So we went from total panic to I don't want to say total euphoria, but you get it. And there's a guy that I follow on Twitter that every time the market's selling off, like really bad, he always tweets, "Crisis creates opportunity." And man, he tweeted that on Monday morning. And every time I see that, my instinct is, get ready. Now it could fall out of bed, it could, but the probabilities are very low. Now the probabilities of this, they're not super high, but they're much higher than the falling out of bed if you look back in history. So I don't want to say I knew it was going to bounce because that would be too easy, but I knew there was a really good chance it would bounce. Now the bounce is stronger and more powerful than I probably thought, but that's always what happens. The market always goes lower than you think and it always goes higher than you think. So you have to be prepared. You have to be flexible. You can't cancel your subscription because the market's down on Monday and then turn around on Wednesday, decide you want it back. For right or wrong, my feeling, you gotta stay in this. You gotta be on top of it. I'm not saying every single day. I step away from it as well, but information just moves much faster nowadays than it used to. So uh, I happen to be on IBD Live on this day. Normally I wouldn't be, but that's Monday, and I just remember one of my. I'm going to beat my own chest for the very first time. And if I've ever beat my chest on this video, it was by accident. But I was on Ivy Live that morning saying, if you have hedges, take your hedges off. They did their job. If you are short, cover your shorts, at least most of them, if not all of them. I didn't have any hedges because I don't really hedge. If I think if I don't like stock, I just get out. It's going down, I just get out. I don't hedge it. If I think something's going down, I might want to speculate that it's going to continue down, then I get short. I'm not hedging. If I'm long XYZ and short ABC, I'm long XYZ because I think it's going up. I'm short XYZ because I think it's going down. Now, in theory, they might hedge each other, but that's not my objective. So I covered like 80% of my shorts, and honestly, should have covered all of them. The 20% I didn't cover is significantly higher. Now I had to get out a handful of days ago because they just were much higher than my covers. So I got it mostly right. And look, there's a chance it could fall out of bed. So there's a difference between covering your hedges and taking the shorts off for sure. But I think that's why you hedge is for something like that, and then you're back basically positioned in the names you like, whether it's Nvidia or whatever it might be, and now you've participated in this move up. Don't always work so cleanly, but this one did. So and the VIX was really high. I think I said I was going to mention the VIX last time and didn't pull up the chart, but this is a daily chart, but like let's go to the weekly. So when you get up into this, and this chart's kind of messy, I get it. Let's see if best fit doesn't work either. It's kind of messy. I get it. But when you get up into these spikes, almost always they get pushed down. And now this did it in hours to days, which is a little unusual, but it's just collapsed. It's giving it all back. So when you have this type of spike, you're usually getting close as far as the fear. So, all right, well, all well and good. Now what? Where do we go from here? So we had a follow through day. I think it was this day, August 13th. Relative strength is not new highs. It is an index, but it's comparing to the S&P. So the NASDAQ is not as strong as the S&P, at least here in the short term. It's been the leader, and maybe it turns into a follower. I don't know. We'll have to see. But it's not, I like, as far as the NASDAQ stocks, you'd like that RS line to be a little bit better. So right up into this resistance. And if you're a short seller, like I am once in a while, this looks like a perfect spot, right? You've rallied into this resistance. It worked here, which makes me less, or more sanguine. Is that a word? Here, as far as putting that type of trade on, because then if it worked previously, it's probably less likely to work the next time. And you can see looked like it worked there, and then boom, it just ran up, and it worked here, but then it didn't work there, right? This is kind of what I'm talking about. You get it at one time where it worked, and this is pretty short term, but so I don't have any shorts. I am long 3 or 4 names. So I think I guess based on my positioning, I think the market's going up. I'm willing to change my mind and be wrong, but that's kind of what I think. I think we're going to make a push for new highs, and I think there's a good chance the S&P gets there, the new highs, and then it'll be very interesting at that point. Let me turn my camera off in case you can't see. So we're in an uptrend. You probably should be long something. If you're 0% in our system, you're doing it wrong. You probably should have some exposure. If you're over your skis long 125%, well, I'd say, well, hopefully you're up, 25% on the year or something like that. You're already having a good year or more. And so you can afford to risk a little bit by doing that. I would say I'm in the middle of that. So I want exposure. I can afford to risk some, but I don't want to get over my skis. And if it starts to consolidate and then goes, that'd be ideal. But let's see. So S&P, you see on this spike, it's basically right back to there, whereas the NASDAQ a little bit lower, not too much, but just a little bit lower. Maybe that's contributing to the RS. So if we get to new high, take out this high, it's going to be really key in my world that the NASDAQ does as well. Doesn't have to do it the same day, but I would love to, I would need to see it a lot, within a day or 2 or 3, or maybe 4. It better be within shouting distance of that. Otherwise, you could have a negative divergence where the S&P makes a new high, maybe the Dow makes a new high, but the NASDAQ does not. And negative divergences would be a little bit, it would be a negative, obviously, hence the word negative. It would be a negative for me, and that would either force me to maybe consider shorting something NASDAQ related, tech related, or not being too heavy long. So we'll see. But it's not a perfect double bottom, but we're very close. And there, a lot of the stocks have this kind of look. this double bottom look. So it was a really nasty shakeout. It was quick. It didn't last a handful of weeks to months like they normally do, but it was the price action was, probably compelled the weak hands, so to speak, to act. Okay, so I think I mentioned last week the kind of the similarities, I guess is the word I'm looking for, to 2007. And let's just probably go like to December 2007. Let's go to NASDAQ because it's a little bit more pronounced. So if we advance, I don't think it makes a new high here. There we go. Yeah, this is what I was looking for. So it feels like this. You see how I have that? Everything's great. Everything's fine. You get a little sharp break. Really, really bad break from 2274 down to 23 and change. Oh, I'm sorry. I need glasses. I know, Arusha. 2724 minus 2389. So that's about a 12% break, very similar to what we had, and then quickly into new highs. So that's where you get this kind of what I'm talking about. So if it can get into new highs, let me go to, I don't want to jump to the current. Well, that's fine. Jump to the current one just now. So if we get into new highs, then to me, this area would be important. A breach of that area would be another negative sign. So, based on this kind of analog that we have. So let's go December 2007 again. You get into new highs and then you break, right? You below that, and then you start to live below this moving average, the 50-day, and then you start to live below the 200-day. And, now you're in a bear market. And so I hope this analog doesn't hold. The Charles saw this same analog and talked about it on the podcast. Charles Harris was on the podcast last week, and he talked about this exact same analog. So I thought that was interesting. So the good news is we both see the same thing. Unlikely to work that way. From just a sheer sentiment standpoint, too obvious for lack of a better word. But the idea is if we get to new high, it needs to hold those new highs. If it goes to new highs and then rolls over, that would have me very, very skeptical. And you can see here on, let me go back to December. Now, it's not quite a negative divergence, but this would be very kind of what I'm looking for. Do you see how the S&P made a new high for 1, 2, 5 days? Whereas the NASDAQ made a new high 5 weeks almost. So much stronger. So you had a bit of a negative divergence there. The S&P not going to be as strong as the NASDAQ most of the time, but it shouldn't have that hard a time. If the NASDAQ is powering into new highs and the market is okay, the S&P should be able to at least hold those new highs, and it couldn't. 1, 2, 3, basically about 4 closing days above that, and then it rolled over. So this is the analog that looks, now you always find the analog that's similar that you remember. So another thing, there might be an analog in 1965 that does the exact opposite. So the market goes the other way. And so in the end, this is fun and all that, but like Bill O'Neill would say, just follow the market day by day. So as we sit here now, we've had a fall today. I think we had a subsequent fall today. So a market's strong. It is what it is. You have to kind of respect that. I know it's changed fast, but that's what happens now. And so, market's strong. We're in an uptrend. You're in buy mode. You're looking for stocks to buy. How many stocks you have, how much exposure you have, which stocks you buy. Those are all different things for different people, and a lot of it, I think, for me, for sure, depends on how well I'm doing. If I'm doing well, I tend to be more aggressive. If I'm not doing all that great, then I tend to be a lot less aggressive. Uh, let's talk about gold. I think gold had a good day today. Yeah, made a new high. Very interesting. Gold is very tough. I've been in AEM before, and I just didn't have the patience for this. Should have bought it back, but I just have a hard time handling gold stocks. But this one is acting really, really well, and it's kind of clearing a long area of doing nothing, and the earnings and sales are very good. So I wouldn't fault anybody for having exposure here. Um, the other thing that's interesting to me is China. I think I mentioned last time. So this is FXI. This is the Chinese kind of a big cap ETF. This looks like a double bottom to me. You have a little shakeout. I think if you love China, you could buy that shakeout +3 underneath there. KWEB, which is another ETF. Not quite there, but this would be, you see this little trend line I've drawn right here? That's kind of for me where the shakeout +3 price point would trigger. So if it got through 28, would I buy it? Possibly. I don't know, but I want to know if it triggers that. I do have PDD, and then I guess I could get into stocks later, but and I do own this one, and I don't own BABA, but this is acting a lot better than it has in a while. And there was some institutional, well, I guess it was end of quarter, so we got a lot of 13Fs. And there was some, I think it was David Tepper, who Appaloosa. I should have checked this before I spoke up, but I think he has a position in some Chinese stocks, and he's the owner of the Carolina Panthers now. I believe it's David Tepper, and and Michael Burry has he runs his own money, but it's in a family office, so he has to report his findings, I guess, or his holdings, I should say. He has a position, so it's interesting that a couple of those guys, what I would call the smart money, they don't get it right every time, but have positions in Chinese stocks. Because Chinese stocks, like if you look at KWEB on a monthly basis, from 100 down to 20, and just doing nothing. But when they perform, they can perform. This is a really good trend, 40 to 60, 50% in the ETF, 40 to 100. Nothing wrong with that. So I don't want to completely ignore that area, because as soon as I do that, it'll be the best market in the world probably. But I struggle with how to handle that, honestly. And I feel like, based on like IBD Live and stuff like that, I other people do. Some people say, "Oh, I never buy Chinese stocks." I see that in IBD Live Q&A. That's fine. I don't. It's your money. You have to be comfortable with it. You have to have the conviction. So just because I said I did it doesn't mean you have to. I'm not buying anything just because somebody told me in the IBD Live Q&A that they were buying it. So I don't take it personal. You shouldn't either. Make your own decisions. I just want to provide feedback and market thought process. Like, okay, if China is so bad, why are these stocks going up? At least in the short term. And the other way around, one thing Mark Minervini would always say, if the stock is so good, why isn't it going up? So some of the stocks that I like, I sometimes can hear Mark saying that, like, if it's so good, how come it's not going up? The market's gone up like 8 of 10 days. So in the last 10 days, if you have the stock you've owned and you just love it, yeah, if it's so good, how come if it didn't go up in this environment, it's like, what when's it going to go up? How strong does the market have to be to send your stock up? Now, maybe it's made a big move and it's consolidating that big move. There's a lot of factors that go into that, but I think about that a lot. If it's so bad, the story, the narrative, if it's so bad, why are the stocks going up? If it's so good, why isn't the stock going down? Let's jump to, I think that's it for market. Let's go to the industry groups. Oops, wrong column header. Medical long-term care, steel specialty alloys, oil and gas trust. Beverages, non-alcoholic, telecom, mining, gold, tobacco, media, books. So not exactly screaming that it's the start of a new bull market just yet. Medical hospitals, food, meat, but give it a week or two. Let's see. Let's see what happens. Aerospace, defense. I don't see a lot of the typical types of stocks that lead bull markets, but it could be a different type of market. It could be led by a whole another area. Maybe that's why the NASDAQ is slightly underperforming, because the money is coming out of there slowly, very stealthily, possibly. It has gone up, obviously, into other areas. All right, so let's jump to the stock since there wasn't a lot there. Let's start with all the big boys, of course. So we'll start with NVIDIA. Not exactly a double bottom-ish, but you get the idea. Oh, I know what I wanted to talk about. I do have something I built in there, and this reminded me of it. This whole shakeout thing. So it's another way you can buy stocks is with this shakeout. It's a little bit harder. It's a little bit trickier. I like it, especially in a market that writes itself quickly, because you're not going to get a lot of bases. So like Kava, um, this went up so fast that it's like, oh, I'm waiting for a base. I want to follow the rules. Well, that's fine. I get that. But if you love the name so much, you're standing in line 3 days a week to eat there and you want to buy the stock, it's frustrating to see that happen. So you could have like a little shakeout below this low, or maybe a shakeout below these lows. And then you use the shakeout plus 3 rule, and you could have bought Kava that day right there. So maybe you pay 89 or something and you're up, 8 or 9 points in it already. So I like to buy like that, but with that mindset of what I've quoted from Mark Minervini, if it's so good, why isn't it going up? So if I get a shakeout, I need power off of that bottom quickly. So from a rule standpoint, from a strictly like IBD methodology point of view, from the Bill O'Neill perspective, if you're just like so by the book, you just can't help yourself. I wanted to give you this example. So here's Apple in 2006. And this is the model book home study course. This phrase, or was it in, no, yeah, it was in the model book home study course, not in his book. Why buy here? Question mark. Shakeout plus 3 rule for $30 stock. For $60 stock, raise it to 5 to 6 points roughly. And that line that I've drawn across, that's above the 57.67 low. So that low plus 5 or 6 points would put you at around 57 plus 5, roughly 62. So you get it. It's not a perfect math. You don't want to do 10%. I think the idea is just it should come through that. It should undercut that low, shakeout. Shakeout, there's the key word, shakeout. If you're in Apple and you're not selling that 1, 2, 3, 4, what's that, about 9 of 10 weeks down in a row, you're not a seller. But somebody is getting out, right? Shaking the tree, and then it comes back really fast. That's the idea behind the shakeout. So if I advance, this is what Apple did. If you didn't buy it that week, you could have bought the next week. Now, it eventually builds a little double bottom, and you can just buy the pivot, which is a little bit higher. It's not that much higher. But this is the idea is, got this great company. I want to buy it. Like I talked about with Kava. How do I buy it? How do I buy it if it doesn't build a pattern? And so this is a good example of a shakeout plus 3 pattern that right from the model book home study. And that markup is straight from Bill O'Neill. All right, let's get back to the charts. So Kava leader, I actually had lunch at Kava yesterday at, I don't know, 2 o'clock or something, and waited in the small line. Just, it seems to be the, hitting all the, doing all the right things. Palantir. So again, how do you get into it? I don't know. I mean, it's tough, but maybe a shakeout +3. It's tough. I get it. It's ideally it would build a cup with handle. Sometimes they don't. I don't own either of these stocks. Palantir and Kava just kind of left me in the dust. Race. So this is a little bit more traditional. You can buy that right through the pivot. Acting okay. Shark Ninja. Buy that right through the pivot. More traditional. Now it gapped up. Might be a little bit tougher, but right through the pivot. Shake Shack. Right through the pivot. Not a great pattern, but it is a pattern. So there are some that are giving you patterns. There's a new name, MRX, that showed up on the breaking out today, kind of a untraditional double bottom, but that one broke out and it's a little small, only trades 190,000 shares. I do own this, FYI. $24 stock, little thin. I have to definitely check out the liquidity if you're considering something like this. But a new name, and the last quarter earnings and sales are very good. And the stock acted really strong on those earnings and sales, which is most important to me. I mean, they look good, but I want to see the stock act accordingly. I think I went backwards. So let's go to the big boys again. So NVIDIA, if you just couldn't stand it, you could have manufactured some kind of shakeout buy point. Google, not acting all that great. Not acting all that great. Amazon, to me, just an avoid, total pass. Microsoft, again, total pass. Meta. So Meta didn't have, I guess it looks much worse on the screen than it does on the chart. When I saw it was down 9, it's like, yeah, but it's $500 stocks. It's funny how that works. Stock holding up pretty well, or actually better than pretty well, very well. Tesla, I guess other people interested in this one. It's trying to get above the moving average. I don't know. So Coherent, this is a tough stock. I do own this stock. I did buy this. It's just like, gosh, the pattern, right? So I bought coming out of this space, and honestly, it was either here or here. So I didn't make hardly anything. Got out, was glad I was out, and now have to find a way to get back in last few days. So, but the weekly looks very strong. That volume bar, and look at those weekly bars, really good accumulation. Druckenmiller, Duquesne Capital, it's his largest position. So was I influenced by that? Of course, for sure. So I definitely consider the sponsorship. So from a mutual fund sponsorship, which is important, if I open up this tab, I really like this. These are very small positions. Invesco, small position. Columbia Acorn, really small position. Show fund ownership. I've got some other Fidelity funds that I flagged that have a position in it, but they're all very small. And there's nothing wrong with that because, and look at the fund ownership, the total numbers increasing each quarter. Because if they all probably subscribe to kind of the policy of put a little money down and see how it works. And if it starts to work, let's get more money in there. So that's what Will Danoff says how he does it. I listened to him on a podcast. It's like he used the poker analogy. I put some money into the pot. If my hand gets better, I put more money into the pot. If my hand does not get better, I check or fold. And that's just a great way to think about it if you play poker on a home game simple level. Obviously, on the higher level, the guys are bluffing and 3-betting at each other and all kinds of other strategies, which are very powerful for that game. But from the simplest way to think about it, from the stock market point of view, you put a little bit of money down, If your hand improves, you put more money into it. So if I buy Coherent and it improves, if it goes up, I give it more money. If it goes up more, I give it more money within reason, within a point of not jamming my average cost too much. But it's definitely how you want to do it. So I'm hopeful that that's what these guys are doing. If I look at the monthly chart, I sometimes look at a monthly and, it's gone nowhere for 4 or 5 years. I don't know the business super well. I know enough to be a tiny bit dangerous, and I know enough that I'll put my money down and risk some of it. I guess to me, if I understand the story of what I've seen in podcasts and YouTube videos, etc., and I talk about this a lot, if AI is real, if it's real, it's going to need a ton of power, and it's going to need a zillion data centers. Let me Maybe I will show you this slide. Oh, I think I deleted it. Maybe next week I'll talk about it. But I had a slide that showed, it was like a histogram. And I guess in the US, there are more data centers in the US than all the world combined. So if there's 1,000 data centers in the US, there's 900 in the rest of the world. So who's going to power all those data centers? That's why I like some of these power players like VST, which I'm honestly a little disappointed in, because again, if it's so great, Scott, why isn't it going up? So the market's been really strong and it's kind of lost its. I really wanted to see that. So I'm wondering if maybe I'm wrong on that. TLN made a new high. Really tough stock, very choppy, but that made a new high. CEG, I've got this line. I want to see it get through there. But the data center play, right, seems logical. And maybe that's what the Fonz and Druckenmiller are thinking on Coherent. They're gonna need that capacity. Oh, I apologize. I think my screen was paused. It said it was paused. I apologize. Just in case. So I talked about VST. Or, if it's so great, why isn't it going up, Scott? Okay, well, I really want to see that. TLN, I think I mentioned, new high, but really choppy, tough stock to own. CEG, got this here, the shakeout +3 line. I want to get, if I'm considering that, I don't own that. I have to get, I want to buy it higher. I want to see some power, and then Coherent, same thing. So that's pretty good power. Goes from 80 down to 52. Wow. But then quickly writes itself almost all the way back to 80 in a hurry. So now, where's the buy point? Again, that's tough. The buy points right now are very difficult because of the nature of the market. It's very V-shaped. Why is it V-shaped? Well, look at the market. It's pretty V-shaped. Even the S&P it's pretty V-shaped. So the patterns develop almost exclusively based on the market environment. Double bottoms, cups with handles. They develop they're heavily influenced by the market that you're in. So you have to consider that. If you're looking for like a perfect cup with handle in this market, let's say the market goes up to new highs sometime next week, there ain't going to be any cups with handles, at least not stocks you probably want to own. The best names not going to have time to build a cup with handle. Cups with handles and double bottoms, they're built in periods like this. All right, I think that's it as far as the stocks that I wanted to talk about. All right, let's jump to the quote of the week. So I was listening to Advanced Workshop with Bill O'Neill, and David Ryan was in these, and they're very old tapes that I have, and they're very nostalgic. And once in a while, when I need to get back on the horse, if you start to believe, breakouts don't work, if follow through days don't work, and we all go down that road. We all start to wonder and question. So you're not unique if that's you. It's nice to get back on the horse a little bit. Now, I am of the opinion, right or wrong, that the market is a little different than it was in 1991. So, but the principles, the philosophy of money management, adding to winners, cutting losers, uh, listening to the message of the market has not changed. I was listening to Bill talk about the news coming out of the market and its market's weak. And maybe it was the Iraq war, 1991. It doesn't even matter. It was as if he was talking about the current market. I could see him saying, "Oh, the news comes out of the blue. You've got this yen carry trade that's blowing up, and what do you do as an individual investor?" It's the same. And he was talking about Vietnam War, same kind of thing. News came, and this was in 1991. He was talking about a historic event. For the Iraqi war, news comes out of the blue. What do you do? So it's all the same. News comes out of the blue. The market's weak. There was some distribution. The market did give us some classic sell signals, but it happened pretty fast, admittedly. So news comes out of the blue and the market's weak. What do you do being an individual investor? If you got 5 stocks, and this is key. So Bill just didn't believe in having 20, 30 stocks. And this is why. If you got 5 stocks, let's say they're all 20% positions, and you sell one of them, you're down to 80% invested. You're bending with what the market is telling you to do, not what you think or what you believe. This is another key. So the market is telling you it's weak. Heed the message of the market. You don't know why. You don't have to know why. You have to look at your portfolio and decide whether I keep 4 stocks or 3 or 2, or whether I should be all out. The nice thing about having 5 stocks or even 10, I think 10 is fine. 12 is fine. 16, 22, 30. It's just too many, I think. If you're right, you're not going to have performance. If you're wrong, it's hard to get out. Like if you got to get out and you have 30 stocks, you might sell 10 of them, but you've only reduced your portfolio by a third if they're all equally weighted. That's one of the downsides. The other downside, at least I think, is performance. The only way to really have a really good year is you got to have a significant position in 1 or 2 good names once in a while. And that significant could be, for me, a significant position would be 25, 30%, something like that. I don't really usually go much more than that. I used to in my younger days for sure, but not any longer. For you, it might be a little less, or it could be a little bit more for some of you that are more cowboy-like Jim Ropel would say. So you have to look at your portfolio, decide whether I keep 4 stocks or 3 or 2, whether I should be all out, right? That's what he talks about. Selling rules. You got to have some sell rules. It's no fun to watch you sell them and watch them come back. I would say I'd rather do that, watch it come back and buy it back, or than watch it fall apart. On a Monday, come in, the Nasdaq's down 5%, and then it closes down 12%. I didn't think that was likely, but it was not impossible for that to happen. It was the tiniest probability in my estimation of that happening, but not impossible. When I was buying stocks there, I had to tell myself, this could fall apart. So be wary, be nimble, be willing to, if I buy something now, maybe I need to be out of it in an hour or 2, something like that. I don't want to be out of it in an hour or 2. I'm just going to have to be if the market just can't right itself. And what Bill said, and there was a lot he said in here, obviously, but then he said one thing that jumped out to me. Another thing is, been in the market for 30 years. And one of the reasons I'm around here is I would sell a stock if something's not working. Nothing is sacred. That's what's kept him in the business for all those years. Live to fight another day. He would always say that, he kept talking about that famous saying, sell down to the sleeping point. If you have something that's bothering you, get out. Most people, they can't get completely out. It just psychologically just borders on impossible for them. I would say, get out. And Bill would say, he said it a number of times, get out of something. Get out of something. So If you can't sell NVIDIA, you just love it too much, sell Google, sell Amazon. Or if you have 1,000 shares of NVIDIA, sell 200. If it's so good, it should stop. And a lot of people think, well, every time I sell, it goes up. And I've thought that as well, right? So perfect, perfect. Sell it and make the other 800 shares you have go up. If you're that powerful, if you're that good that every time you sell something, it goes up, just get out of 20% of it. And then you might say, well, the market knows until I'm completely out. Well, at least then if you did that 5 times, every sell would probably be lower and you'd have a better fill than if you waited all the way to the end. So selling is very, very difficult. I get it. It's not, I think Scott O'Neill used to say it's like five or 10 times harder than buying. And I agree with him. It's very difficult to sell. So, but you have to learn how to do it to protect yourself if you want to be around. And he went on. He had a number of stories. This is even in 1991 of people that he knew that couldn't pull the trigger. They couldn't get out of something, and they went bankrupt. They let stocks get away from them and totally ruin their overall portfolio, which just doesn't make any sense. Having a sell on a single name, if you have a sell stop on XYZ, let's say you own 10 stocks and XYZ is 20% of your portfolio, by having a stop on that name and all the names, it's like insurance on your overall portfolio. What if XYZ went down 80% and you had a 20% position? All other stocks, even if they went sideways, you can see the math. You'd be down, what, about 16% off the highs from that single name. What if 2 names did that? 32% down. So if you just get out, you're protecting your overall portfolio. Oops, sorry. I don't know why I had that. Contact us, 800-831-2525, marketsurge@investors.com. Have a great weekend, everyone, and we will see you next week. Bye-bye.